Welcome to TheoTrade. This is Don Kaufman. Here we are. It's March 2nd, 2018, doing the Theo weekend update. First and foremost, wild ride once again in this week's market action. We blow through the expected move in the SPX to the downside. But you know what? When I think about this week as a whole, hey, welcome to volatility. Check your bias at the door. And that's really for those that are showing up on an intraday basis. I got to tell you, throughout the course of this week, when the markets are selling off on Tuesday, the markets are selling off hard on Wednesday, on Thursday, some wild sell side activity. It was like everybody was showing up on an intraday basis, waiting for the rally ultimately to take place that never ultimately took place. And that's really what I wanted to start with here on this weekend update is, if you have a bias, and again, with all due respect, this is on a day-to-day basis. We're not looking at long-term investing just yet. But if you're coming in here with a bias and each and every day, you've already lost the battle. And that's what volatility is really about. Volatility is about this enormous opportunity, but you gotta check the bias each and every day at the door. Now, throughout the course of this week, let's switch up the gears a little bit and let's maybe look at the longer duration and some of the bigger issues I think that are taking place in today's marketplace. One of the things that has been brought to my attention throughout the course of this week is, I got a client and he was emailing me specifically about beta and beta weighting. Now, for those of you that have absolutely no idea what beta is or beta weighting, it's an underlying relative movement versus the S&P 500. And I just give you a quick example. The S&P 500, no matter how fast or how slow it moves, okay, is always going to be considered a beta of 1. Now, if you have a stock that has a beta of 2, that means, roughly speaking, your stock is supposed to move, 2% relative to every 1% move in the S&P 500. So anyway, this gentleman emails me and he says, hey, this beta weighting thing is not working. So I started looking into it and deeper into it, and something really struck me. And this is a big issue for market structure right now. Low beta stocks are getting absolutely annihilated on a day-to-day basis. The bigger and broader issue is that your higher beta underlyings, and those are what we would kind of construe right now as the generals in the marketplace. If you take a look at something like Amazon, has that been hit? And this is a high beta underlying that hasn't really been hit. You start looking at Apple and a couple of the major tech stocks, which are, again, they're kind of unscathed in this entire sell-side activity. And that I don't look as a positive. I absolutely look at that as a negative. Now, when I'm saying these low beta products are getting hit, what am I actually referencing? Well, let's go back for a moment. When the Fed came in a couple of years ago and they started just crushing yields down, right? Interest rates are getting crushed across the board. All of these low beta mutual funds started popping up all over the place, right? So what is a low beta? It's supposed to be a lower risk fund. But by generalization, if you go out and you start investing tons of capital into what's quote unquote low beta or low risk, because those low risk are generating higher yields, right? Higher dividends, then in effect they can become extraordinarily high risk. Well, in a moment, we're going to take a look at a few charts and you're going to start to look at some low beta products out there. I don't know, go look at Walmart. All right, you're going to throw out, oh, Walmart, they had some issues. Okay, go look at, for instance, HYG. Now, it's low beta, it's junk bonds, but it's low beta. All right, go look at something like Lilly. All right, Eli Lilly. And we're going to look at all of these over here, or, something totally off the map, which is like, Tyson's Food. And you're going to find out, or even Verizon, these underlyings are having 10 and 12% moves higher and lower already since the beginning of the year. Some of these underlyings have actually had ranges 10, 12% to the upside, down 16%. Do you realize something like Walmart has a 0.3 beta? 0.3. That means it's supposed to move 0.3% for every 1% move in the S&P. And again, it's not just one or two of these low beta products that are making these wild moves. It's a ton of them. And general speaking, and again, in general terms, most of your low beta products right now actually are displaying higher risk than some of the tech stocks. Now, that is very, very worrisome to me. Now, again, in some of the coming days, and we'll look at some charts here in a moment on a few of those low beta underlyings, but in the coming days, you need to pay very close attention to these videos, because I'm trying to even title the videos right now specifically for what's going on in the marketplace. And if you tuned in last weekend, the title was, volatility, okay, has subsided, but is the risk really gone away? And the answer was absolutely not if you tuned into that video. On Monday's video, I'm screaming on Monday's video, get your hedges back on. You had an opportunity on Monday and on Tuesday morning, get your hedges back on, because we're about to see some sell side activity. And then, coming into Wednesday, it's just a market in complete and utter limbo at that point. And that's really how we've ended this week. Now, it wouldn't surprise me that in early trade next week to see some wild upside behavior to the marketplace. Again, that's much more indicative of volatility, right? Some of the most vicious moves in volatility, again, are to the upside. But I'm going to throw this warning out once more before we actually tune into some of the charts, and that's a really simple idea. Listen, the big market caps, the ones that will really impact the S&P, the ones that are really going to impact the Dow, like the Boeings, they're still on a percentage basis relatively unscathed. And therein lies some of the largest risk moving forward in this marketplace. Let's take a look at some of those charts. All right, a quick commercial before we jump directly into our charts section of this weekend update. Please, we invite each and every one of you to our live Return of the Trader event, which will be hosted right here in Scottsdale, Arizona, May 3rd through the 5th. The first evening, it's kind of what we call cocktails and trading. Probably arrive in Scottsdale on a Thursday afternoon. Cocktails and trading is actually myself, Don Kaufman, along with Jeff Bierman. Then, consecutively 2 days thereafter, we will go into a full-blown class content. This is an early bird special. Again, it's an early bird special. It includes not only the live event, but a full year accessibility to everything that we do here at TheoTrade, and retroactively everything that we have done in terms of classes here at TheoTrade. There are just over 2 days left to enroll for this. Please go to theotrade.com/TheoTrade-live. Again, it's theotrade.com/TheoTrade-live. Now, at this event, I encourage you to take a look at a number of the key sessions we'll be doing. One of those is actually called Return of the Trader, which I'm going to discuss in depth the sell side of options premium and ultimately managing risk. We'll have sessions by Professor Jeff Bierman negotiating intraday volatility shifts, a fractal analysis intensive from Doc Severson. We'll have perfecting your Nasdaq and intraday trading style from Tony Rago, taming the trend day from Corey Rosenblum. That, people, is just day one. Again, really encourage you guys. This is the Return of the Trader live event, May 3rd through the 5th. Again, it's theotrade.com/TheoTrade-live. Now, let's get to that weekend update. All right, so let's get to the charts. First, we'll start here on the SPX and discuss a little bit about the expected move each and every week. So if you guys tune in on a week-to-week basis, what I like to display happens to be what we term expected move. All right, for this, we're going to cut over to the trade tab on thinkorswim. We're going to look into March 9th expiration. That precisely is next Friday's expiration. And cruise with me over here to the right-hand side of your screen, and you'll see the expected move is set at about $56. Now, first of all, how does that compare to the week that we just passed through? Well, the week that we just passed through, we were sitting on about a $43 expected move. Again, that was the week. We saw about a $43 expected move. What did we do? We breached the expected move. Now, we didn't breach it massively. So for the most part, the expected move was right in and around the 2700. Specifically, it was 2703. We ended up on the week at 2691. Nevertheless, it's still yet another breach of expected move. And I've been pointing this out kind of week in and week out. If you look at the year, here's one breach, two breaches, okay? There's 3, 4, 5, 6, okay? And now 7. Oh, really? How many weeks have we not breached expected move? And you have to almost laugh at this because if you've been tuning into these videos for, quite some time, and I'll kind of zoom out for a second, we were like week in and week out, we were not breaching through the expected moves. And this has to do with what I term efficiency and inefficiency inside of the markets. And the markets right now, once again, I said this last week and I'll say it again, they're doing a terrible job of kind of handicapping forward volatility. So one thing I do want to point out. So again, the expected move in the coming week, and I'm saying like, hey, listen, you're expecting about a $56 move on the week. It doesn't mean we can't move $100, but at the end of the week, they're saying like, all right, we should be inside of a $56 range. But just to put that into play a little bit and into context, on Monday, just between here Friday through Monday's close, you're still looking at a $26 move. So there's just no doubt, like on an intraday basis, this is still pricing in to be a fairly wild move. One last point I'll make, in the midst of some of the volatility, specifically here on Friday, we saw the expected move as high as $72. So it got serious as the week progressed. Anyway, just about a $56 expected move. Again, this next week I kind of feel will probably come inside of the expected move. Now, I'm going to get to, what I kind of separate some fact from some opinion here in just a moment. Before I get to that, I want to look at the S&P futures and just, again, make kind of a quick point for those of you on an intraday basis. Now, a lot of people that'll tune in on an intraday basis here at TheoTrade. But if you're an intraday trader, allow me to show you a 30-day 1 hour and just describe a little bit about volatility. So, I started off the conversation with, hey, welcome to volatility. You check the bias at the door. And the reason I wanted to make that point is as you start to zoom into this week, Tuesday, just, we rally out of it, sell off. All right, Wednesday, heavy sell-side activity into the close. Thursday, heavy sell-side activity into the close. And the irony of this was that like each and every day, people are like, hey, I'm going to go out there and I'm going to catch that bounce. I'm going to buy that dip. And they just were getting pummeled day in and day out. So when you walk in the morning and the markets are volatile, okay, and you see an expected move, like if you come in on Monday and the expected move is $20, $25, okay, get rid of the bias right off the bat. You didn't know that Friday was going to rally. I'll tell you what, okay, here's Friday on an intraday basis. You didn't know Friday was going to rally until the last, 20 minutes of trade on the day? And we only ended up 12 handles, 12 S&P points. Nevertheless, again, some perspective here, we were at 2670. 2670 with an hour to go to the close. People, that's a wild rally that you saw into today's close, but we still only ended up 12 handles. Again, when you've got volatility, that's, where people just get ripped apart is when they come in each and every day on an intraday basis with a bias. So you got to kind of check it at the door. Now, the other aspect that I want to talk about is on the investment side of things. And we're going to spend a minute now talking a little bit about quote unquote investments or longer duration. Okay, for those of you that go out there and you sell iron condors, you go out there and you sell a spread, or somebody that goes out and just is long stock. There is, to me, an underlying and fundamental issue right now facing us in the markets. So to display this to you, and bear with me for a moment, we're going to go back to the SPX. Okay, so we're going to cruise to the SPX. I'm going to turn off all the expected moves, and I'm just going to show you a year-to-date percentage. Okay, so here we are, year-to-date. That's your number. For the most part, where do we end up on the year? Massively unchanged. So we've ended up nowhere on the year. But when you start looking at a sector-to-sector basis, like for example, let's take it over to the financials. And we all know the financials, okay, are undoubtedly one of the heaviest sectors. Where are they? Okay. Oh, they're up just shy of about 2% is the XLF. So the XLF is a little bit of a stronger point, okay, amongst the S&P. But then, and this starts to get a little worrisome, you start looking at technology. Tech's almost up, still 5% year to date. It's a fairly large divergence. And then you can go over to, other major indices if you would like. And the IWM is pretty much flat on the year. It's actually down about 1%. So again, it's undoubtedly tech, all right, that's strong. Financials are strong on a relative basis. And one of the things that really kind of intimidates me about this marketplace is, as I said earlier, low beta stocks, like the stuff that's not supposed to have a whole heck of a lot of risk, is having a lot of risk. And, listen, Walmart, you could probably point out, oh, Walmart, well, yeah, but that's an anomaly. Okay, but Walmart happens to be, and I just want to let you tune into this for a second. Let me just close up that left side bar. And that thing is a 0.29 beta. That's a 5-year beta. Just to be fair, it's a 5-year beta. And what that effectively means, this thing's supposed to move 0.3% for a 1% move in the S&P. But look at it on a percentage basis. Like, this is the stuff that's getting crazy. Here's the beginning of the year. We're flat. We go up, what? 11%. Okay, we sell off. We're flat. So then it drops by 10%, rallies up another 5%, drops flat on its face, and now we're down 10%. Okay, from ultimate high to low, people, you got more than what? A 20% move in Walmart. You're like, oh, well, okay, that's Walmart. But you're going to see this, and I'm going to even pull up stuff that isn't necessarily liquid. Here's like Tyson Foods. This thing doesn't move. Again, for the most part, I've been watching underlyings like this for years. 0.27 beta, right? Only has about a 1.6% yield on it. Nevertheless, this thing's down almost 9%. Okay, all right, but that's, it's a food stock over here. So then I started looking at some of the drug stocks, and I went over to Lilly, and I was like, wow, this thing down about 8%. Now, again, I'm being very specific, right? Oh, but that's some of the healthcare. That's, I can go into biotech over there. Okay, let's go to let's go to Verizon. Well, that's down about 10%. When you start looking at the low beta stuff, and again, Verizon's right there, low beta. You can look at like AT&T. I can go on and on and on about all the different low betas. Then I started pulling up stuff like HYG, which happens to be the, it's high yield junk, but junk debt. This thing doesn't move, and it's down about 2%. These are wild moves, again, inside of even the junk, and junk is yielding close to 5%. So again, I can go on and on about low beta underlyings. Now, the issue I think that faces us is when you start looking at tech. Most of the tech is much higher beta. And specifically, let's just point out Walmart, okay, versus Amazon. So Walmart's getting absolutely hammered. Amazon's up 26%. This is the point that I'll make, and I'll leave you with this thought on this high beta versus low beta. And you could construe that Amazon is quote-unquote higher beta. Over the last 5 years, it's about a 1.5%. So it's the other side of spectrum from a Walmart, okay? And I'm going to pick on Amazon for just a second because the point to be made over here, if you believe that volatility is going to continue, I'm not asking you if you think that Amazon's going to sell off, but if you think that volatility is going to continue, okay, there's a phrase that's been used in volatility since, umpteen years in the market. They're going to start hitting the market. They're going to hit them all. And Amazon, okay, this thing is only 3 days removed from its all-time high. That becomes scary when you start looking at specific tech underlyings. All right, here's Netflix. Oh, don't worry. It's only up, what? 50% on a year-to-date basis. Then, again, I'm looking at tech. That's not fair, Don. You're just looking at tech. Well, let's look at another underlying in the Dow that they did start to hit today. Boeing. Boeing's still up 16%. And I got to tell you right now, I got, a chip on my shoulder for Boeing. I'm in a short position over here. It's big, okay? And looking at Boeing, I'm telling you, there are a number of key underlyings that are propping up this market that are heavy market cap. And if we keep seeing volatility, they are going to annihilate a number of these big market caps. And it doesn't have to do, with Amazon being a good company or not. Ask yourself, is Amazon packed into a mutual fund with a bunch of other stocks? Absolutely. Is Amazon one of the heaviest market caps out there?
Absolutely. Then they have to sell Amazon if there's going to be a redemption to a mutual fund. So the bottom line is, if volatility continues to the broader S&P, you will see an underlying like Amazon get decimated on a percentage basis. It's up 26% again year to date. It's something to think about. And again, that part isn't so much of opinion. That's just knowing what will happen in the midst of some volatility. Now, okay, moving forward, this coming week, here we're going to get into a little bit of an opinion piece now. This coming week, of course, you're going to expect more volatility. Specifically, let's start with the XLF. One thing that you got going on the XLF, check out the expected move for the week. I mean, this thing's up to 72 cents. Now, the XLF, all right, this holds the keys to a lot of what's going on inside of the market. Now, here's my real inclination. And again, simply a feeling. Early in the week as a whole, I think we'll actually see the S&Ps possibly rally back up. All right, it wouldn't surprise me to see on Monday follow through to the upside inside of the S&Ps. Okay, plain and simple. All right, but hey, listen, that's only like a day or two into it. I think we might see what we kind of call a snapback rally. If we see sell side activity though come in Monday, okay, that's where you got to put your helmet on because we're going in and it's going to be a long road to the downside. But I think we could see a snapback rally. All right, here's another big opinion piece to the future. And this is important that you understand that this is my own opinion on markets. Okay, this week we heard a lot about, the steel taxes and, you have to ask yourself, is the administration really against the markets right now? So originally the administration was, talking about the markets, propping up the markets. It's now, and again, all politics aside, it's now my belief the administration is quietly, against the markets. And the way that they're going to do this is twofold. Number one, they're going to do things like, steel tariffs. And they're going to say, don't worry, over the long run, that's better for the U.S. economy. And hey, listen, again, all politics aside, they're going to say it's better for the U.S. economy. But you have to realize that there's this underlying kind of bias there. And I actually think that the administration is trying to intentionally cool off the marketplace. Now, this has been done time and again. I mean, that's what the Fed also does. The Fed is there to do what? To pop the possibility of a bubble. I'm not here and I'm not going to start talking about is this a bubble or not? Okay. I don't know. Look back over a 10-year chart. That's pretty intimidating. And this could be construed possibly as an asset bubble created by the Fed. So the administration at this point is, putting on the steel tax, which was looked at as a little bit, of the anti-marketplace. Now, secondfold, the Fed. And the Fed this week came into a lot of, scope simply because of Jerome Powell. Nobody knew what to expect. I talked about that last weekend. Nobody knows what to expect out of this guy. Well, I'm going to tell you, here's my opinion. Okay. He's going to come out and he's going to come out swinging. All right. Why? He's going to come out very, very hawkish because they might look at this as an asset bubble. And they got to raise up interest rates. They know they have to do it. And they have to raise interest rates, before we do actually go into another recession. I'm not saying that we're going into a recession. I'm just simply saying you got to get rates up before, the economy does eventually have cycles and the economy would eventually backslide. So you have to look at the Fed. The Fed might be out a couple of years and they're thinking, okay, maybe in 2019 or 2020, we'll backslide into a recession. They got to get those rates up right now. Why? Because otherwise, if we did slide into a recession, they got nowhere to go. What are they going to do? Let's turn the juice back on. And you have to realize the Fed right now, they don't have your back. And I think that, again, some of the politics coming out of Washington specifically and the administration is right there with them by going out there. And, if you think that they're doing deals that don't necessarily make sense, put it in perspective. It does make sense. They're trying to cool the market, not necessarily the economy, but cool the market. By number one, being a little bit more hawkish on rates, and number two, bumping up some of the taxes. And again, that is not going to be openly probably discussed. So moving forward, I think the market has really substantial headwinds. And again, completely opinion on my behalf. Now, what the implications are? I'll tell you exactly what the implications are. It's called trade or die. That's why, we're doing this whole thing in 2018. It's called return of the trader. You are going to have to make, okay, decisions continuously. This is not going to be about, let's just buy something and hold it. Okay? For the foreseeable future, you're a trader. Investors, meaning like I'm going to go out and buy a stock, it's going to be extraordinarily difficult. We'll be able to find positions from time to time, but we're getting back into the idea now of selling some premium. With that, I want to thank everybody for joining us on this weekend update. Have a wonderful weekend, everybody. Bye-bye.